Welcome to the daily update, where I'll go over the action in the market for Tuesday, November 13th, and then we'll see how things look for Wednesday, November 15th. We had a really solid update, and it was pretty much broad-based. A lot of the areas that had been under weakness lately, they saw some real strength. It was like nonstop love across the market if you were into the stock market. The markets really liked the CPI report that came out. There was positive reaction to that. The futures immediately spiked up. We ended up gapping higher right at the open, and we held on to those gains throughout the day. Let's go back and talk about what happened. Right at the open, we had a gap higher open above R1 at 44.24, also R2 at 44.37, and R3. And that doesn't tend to happen very much these days. I had to break out the pivot point calculator. That was at 44.65. We even got above R4 at 44.93. Then we hit resistance at 4,500. It was just in yesterday's video that I said, well, things were still kind of positive. We're still above 4,400. Now we're back to dealing with 4,500. As the day went on, prices rose and fell about the 4,500 level to the upside, and even went above that a little bit and about to the R4 on the downside. And we closed slightly above R4. We were up 1.91% on above average volume, and our technicals are positive, yeah, but we're overbought. We're also showing kind of an extreme reading from one day to the next that I'll show you a few charts from that. And it's because of inflation, interest rates, growth concerns. The market likes what came out, and so there was positive reaction to that. We're also dealing with earnings season as they are being released by each company. And then the big geopolitical event continues to be what's going on in Israel. Also notice that I've switched from using Google Slides. I'm back over to Microsoft PowerPoint, so it might be a little bit different. Some of the slides might be kind of out of order. I tried to reorganize them a little bit here. What are some comments that we can make? The CPI report that came out, it was taken as quite market friendly, and then stocks ended up having a broad-based rally. The S&P 500 is slightly below 4,500 after trading above that level during the day. And then value did outperform growth. This is a little bit of a warning sign. When you see a broad-based rally like this, it wasn't necessarily the mega caps, although they did well. It wasn't necessarily growth stocks, although they did well. But value did outperform growth. And small caps were even up 5.43%. Now, we need to be aware of this. There was the Friday before last when we saw small caps and mid caps really go higher, only to spend the next 3 or 4 days giving pretty much all of that back. Is that going to happen this time? Or are we going to get set to really see things start to march higher? Oil did close down at 78.15. That really didn't change all that much. It was an extreme one-day move, and I have a few charts where we have special days like this that I'll break out and show you. On a short-term basis, we've got a pretty long list, so we are extreme positive. We have the 20-period exponential moving average study, the Stochk RSI, the Williams percent R, both CCI indicators based on 14 and 20 periods, the stochastics, the standard deviations chart, the boom indicator, and the RSI based on 9 periods. So yeah, we're getting pretty extreme right now. In the intermediate term, we also have kind of a long list. The CMB composite, which has been there for a few days. One that we don't see very often is the TTM squeeze. That's getting extreme positive. The PMO studies, which had already been there. The rate of change going back 10 periods, that has been there. A new addition is the S&P 500 McClellan oscillator, and then the percent B indicator with the Bollinger Bands, and I'll show you charts of all of these. The current scenario, and I've modified that a little bit, the idea is that the Fed will need to keep rates higher for longer, and that's already happening, and they've said they were going to do that, and it's what we're experiencing. But now the scenario is shifting a little bit to perhaps the Fed is done raising rates, or possibly the market is developing this scenario that they may even cut rates into the future. Not necessarily right now, but remember for 2022, the market kept feeding into these positive scenarios only to have it dashed when Chairperson Powell would come out and say something just to blow it apart. A lot of the choppiness we saw in 2022 was caused by that. And then a few days would pass and then a new scenario would develop, and that would drive the market up only to have it come back down. Well, we want to be careful of that this time. The Fed really hasn't come out that I know of and said anything about possibly cutting rates. There's been no mention of that, but the market may still run with that scenario anyway. We're also keeping an eye closely on what's going on in Israel. We're watching oil prices, but they don't seem to be as relevant, at least right now. And then earnings as they are released. The dollar was down. It really got hit in Tuesday's session, and interest rates were also down. I have charts of both of those. The 10 to the 2 and the 10 to the 3 month. Our 10 to the 5 year, which had come back on the list, it's now dropped off again. It's gone back to being normal, but we have the 10 to the 2 year, the 10 to the 3 month. They are still inverted. Sentiment really ticked up. Instead of being negative, we switched back over to neutral at 47, where we had been at 41. Our trend is also changing. We're above the moving average now with the ADX. So that shows that we're in a strengthening trend. The green line's on top, so it is positive. So now we're switching over into a more positive trend environment. The bias is positive and our momentum is also positive. And for those of you that are new, the bias is usually just one day. If we had an up day or a down day, sometimes I deviate from that a little bit, where the momentum is the last 2, 3, 4, 5 days or so kind of taken together. This is the most subjective part of the video. I try to let the charts speak for themselves, but I actually come to the conclusion when it comes to bias and momentum. So you may agree or disagree with the conclusion that I reach. The economic reports that came out, of course, we had CPI. It came in unchanged. They expected it to be up 0.1%. Last time it was up 0.4%. And then the core CPI, this is what everyone pays attention to for inflation. It came in less than expected, up 0.2%. They had expected it to be up 0.3%. Last time it was up 0.3%. Now, I'm adding a little bit more chart since I'm switching back over to PowerPoint, so you'll get some title slides along the way here. This is the CPI report that came out where the blue line is showing how it's going down. That's the total CPI on a year-over-year basis. The core is the yellow line, and both of these are declining, and the market really likes that. Then we have our chart, just to show how things have changed. The top part of this chart, actually, it would be in the middle, the way you're looking at this, and there's an explanation up here on the left if you want to go more in depth with that. We look at this on a year-over-year basis. I use the rate of change 12 in order to do that, and it shows how we are going down with inflation. Then on the bottom, we have the rate of change month over month, and it's also showing that at the headline number, inflation is going down. Then we have, when you take out food and energy, of course, the things that you have to have in order to live, but those things are quite volatile, and so they take those out of the report. We're also showing where when you take out energy, that's the blue line, that is declining. And the core commodities actually are pretty much flat right now, but they have been declining. And then we have our chart looking at core CPI showing the year-over-year basis is declining as well as the month-over-month basis. Then we dropped with interest rates. With the 10-year yield, we're down to 4.44%. That's still above the 4.02%. So that's still a concern for company earnings. Then some intraday analysis. Here's the intraday chart where we just spiked up right out of the gate. You notice I had to add these lines on here. The software doesn't calculate R3 and R4. So I had to go and calculate those myself and then put them on the chart. But we got above R1, R2, even R3. We jetted up to R4. And it looked like, okay, are we going to come back down? Well, we did a little bit, but then we danced right along this R4 level. Then later in the day, we tried to shoot up above 4,500 again, but then fell back and closed right at about R4, just a little bit below 4,500. This is another chart I haven't shown in a while. This is an intraday chart where it takes not only what happened during the day, that's kind of this yellow area where I'm circling, and then it takes the pre-market hours, which are in blue, and then the aftermarket hours, or extended hours, you could call them. That's over here in kind of a pink area, just to get an idea of what was happening, where the futures shot up. Now, this is the SPY, but it follows the S&P 500 futures really closely. And then we shot up before the market even opened, and then we stayed pretty strong, and we're pretty much flat as we go into the initial overnight session. Looking at growth versus value, this is where we're a little bit concerned. They were both up, both the red line and the blue line were up, but growth didn't necessarily outperform. It actually underperformed when we look at the ratio between the S&P growth to value ratio, and that really dropped. So could it be that this strength that we were seeing, that's when the smart money was actually doing some buying? Then we got the huge gap higher, and now they started to sell into that. Now they were both up. It's just that growth underperformed value. Then I look at this on an end of day basis. This is a chart that I get from some software that I watch during the day. Over on the left, this is large cap value, which was really up strong, and then large cap growth. The fact that all of these are green means that everything was positive. In the middle is the corresponding ETF that goes along with that. But we can see where value outperformed growth for the large caps, the mid caps, and even the small caps. Here's an end of day chart showing the small cap growth to value ratio, where it actually ticked down a little bit. I brought this up in yesterday's video because it looked like we were showing some improvement here, but with the big upward move, this declined. We ticked down just a little bit with mid-cap growth, but this has actually been looking a little bit more healthy lately. It's actually breaking out above these previous highs. Then we look at S&P to growth to value, and that actually went down on an end-of-day basis. Something just to be aware of, could be a warning sign. Maybe this is folks just buy low, sell high, and they're locking in some profits. We want to see how does the market handle it going forward here. We're also looking at this, though, and this is more positive. A different measure of growth of value is continuing to show that growth is really outperforming value on this chart. Then we look at trend and volume analysis. Here's our trend. We're coming back across the moving average now with the ADX. So that shows it's a strengthening trend. The green line is on top, so that is positive. And in the short term, we're crossing above the moving average with the green line on top. Both are above 20. That is a positive trend. Volume picked up just a little bit, but we've been really waning over the last number of trading days, even though it did pick up to above average, at least on an end of day basis. Looking at sentiment, this is the VIX. We are really dropping with the VIX right now. We're probably in this area here in November. And then the Ulcer Index continues to fall. That's another fear gauge. And the VIX with the line chart did decline, as well as the bar chart. Now, we've already been kind of low. We're well under 20 with both of these charts, but there is still more room to drop here. And volatility is also dropping off with the VIX of the VIX, with the bar chart, as well as the line chart. The VIX to move ratio continues to really decline, showing that stocks are less volatile than bonds, because stocks have been going up the last couple of, well, at least in Tuesday's session, where bonds have been going down. And then here's the VIX to the 3-month average of the VIX, showing that this is continuing to drop. Now we're into some kind of other areas here with the VIX to VVIX ratio. This is continuing to go down. So that would be positive for the market. But when we look at the equity put call ratio, it really dropped off here on the daily chart. But when we look at the 5-period simple moving average, it's continuing to go up. So it hasn't rolled over yet. And longer term, we're also continuing to go up with the equity put call ratio. It hasn't rolled over yet. Now it could, but it's just not getting picked up, at least at this time. We did see a decrease with this fear gauge, as well as the other fear gauge that we follow. Some advanced decline line studies were back above the moving average and looking more positive based on price. We're still below the moving average based on volume, but also showing some improvement. And this is where we saw a real nice internal strength here. We just saw a total breakout of new highs and almost no new lows. So our 5-period and our 10-period are going higher. Accumulation distribution. This is trying to show what the smart money is doing, and it suggests they are still buying. The chicken money flow didn't really change all that much, but this is still more positive. This could be some of the gross selling that may have occurred. That's pure speculation on my part. The advanced decline ratio is looking positive, both with the blue line and the red line. We're above 0. We saw a real improvement with the cumulative NYSE advanced decline line. We're starting to come back up and go above this trend line with our regular advanced decline line for the NYSE. Saw a little bit of a tick up here, but we're still working off of a death cross with this other NYSE advanced decline line study. And looking at our whole list of different advanced decline line studies, showing some improvement with the NYSE coming back up to the moving average. The S&P is broke above its moving average, as have the mid caps. The small caps are showing some improvement, but they're still below a declining moving average. Our short-term analysis, here's the daily chart. We broke above all the trend lines that we've been talking about for the last few weeks here. we're just well above it. Now, are we going to be able to stay up here? This is quite a gap on the chart. We have this pivot point here that may provide overhead resistance. Are we going to fall back and fill this gap? If we really start to come back down, will this longer term trend line now act as support? On the bottom, we can see for the first time in quite a while, we were above average with volume. Here's the 1-day charts, and this just goes from Monday to Tuesday, where I look at the advanced decline ratio, and we're pretty extreme. Doesn't mean we have to stop here, but a lot of times it just means when you look at other times when we had a really strong up thrust day, there are two ways that you can look at this, that we went up too far too fast, or that this is showing good momentum. And with all of the indicators that I show that are getting extreme, try to look at them in that way, that yeah, they're extreme. Doesn't mean we're going to turn around and go down. Okay, but that could happen, or that this is just suggesting that we're finally seeing some good momentum here, and we might end up seeing some kind of follow through. And then looking at the advanced decline line percent, it's also pretty extreme positive. And we haven't seen one of these since last spring, where this one really chopped up, and then we ended up going sideways with the market. Looking at our 20-period exponential moving average study, we're starting to get extreme. Again, is this momentum or are we overextended? We're seeing some improvement with the 50 and 200-day moving averages. The Stochc RSI is still extreme positive, as is the Williams percent R. The CCI 14 and the CCI 20, they're both back on the list now. Our stochastics, which were already extreme in all the different time frames, continue to be extreme across the board. The force index is getting above its Keltner band right here, so that means it's going up pretty far, pretty fast. The boom indicator based on 20 periods, that is above the 100 level. Again, this could still go higher. Doesn't mean we're going to turn and go the other way necessarily, but we are showing that we could be seeing some exhaustion. And what this indicator tries to do, I developed this years ago. I didn't come up with a name for it until just a couple of years ago, where you kind of get above or below the moving average, and then you boom, go back to the moving average. Somebody said that in an online webinar that I went to, so that's what I ended up using for the name. We're also showing some improvement with the 50 study and the 200 period study as well. We're looking pretty extreme when we look at our standard deviations chart. We're at the very top end of the +3 standard deviation. The rate of change going back 10 periods, we've dropped off a little bit after Monday. Well, we're right back to looking pretty strong after Tuesday. Some intermediate term charts. This is the balance of power, which is looking positive. The CMB composite, which has been extreme positive, is now back to being a little bit more extreme. We're turning to a darker shade of blue, which tends to be more positive for the go, no-go system. And we're breaking out above our highest high value. The line hasn't even had a chance to really catch up with that yet. And the midpoint continues to go up. This is positive. And here's the TTM squeeze. And again, I put this line on here. So I just kind of look at a long-term version of this chart and then eyeball it and come up with where the black line should be. But based on this, we're getting into kind of an extreme reading. The ease of movement going back 14 periods is above zero and advancing. That's positive. The Arun didn't really change all that much. It is positive with the oscillator above zero. And here's where we're starting to get extreme with the S&P 500 McClellan oscillator. And we're seeing where the summation index based on price and volume are looking more positive. It would be even more positive. We already broke above zero with volume. Can we break above zero based on price? The NYSE McClellan oscillator is looking more positive, but it's not extreme yet. So we're going up with the NYSE summation index based on price as well as volume. And this is finally a change. We've been seeing this coming down, and I thought this might be a warning sign. But with the big update that we saw the Swenlin trading oscillator turn back up, both based on price and volume, and go back above zero. On a momentum basis, we are positive with the PMO, also based on price and volume. We're getting extreme with the PMOs that are rising. We're getting extreme with the buy signals. We're still positive with the PMOs that are above zero. We have switched back over to positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR system. We're positive with the short-term slope oscillator, and we could be getting to an extreme reading here in the short term. Intermediate term, we're looking more positive with the MACD continuing to show advancement. And all of our oscillators continue to be positive. The top two are short term, the middle three are intermediate term, and the bottom two are longer term oscillators. We're above all the plotted moving averages in our moving average tree. The longer we can stay up here, the better these lines will start to look. The Sean trend meter, haven't shown this in a while. We went from this sickly yellow area to kind of a sicker looking green area right now, but it is looking more positive. The bullish percent index, this is kind of big too. We crossed above 50, and that's a technical alert trigger. Those of you that watch the intermarket analysis or deep dive videos, I forget which one, that stockcharts.com has all these technical alerts. Well, when it crosses above 50, that's kind of a big deal. And we are showing some improvement with the NYSE bullish percent index as well as the NASDAQ 100 bullish percent index. And we're not extreme with any of these. The Chaikin oscillator is going back up and is above zero. That's positive. The money flow is positive. The ultimate oscillator is positive. The vortex is positive. The percent B, that we're getting just to the upper side here. What happened here is we closed just a little bit above the upper Bollinger Band, and that doesn't happen very often. Somebody did some research and said we only spend about 3% of the time, or is it 0.3%? Just a real small amount of time actually outside of the Bollinger Bands. And so that has a tendency to say that we could see some kind of a move in the other direction. It doesn't necessarily mean there has to be a big price move, but eventually these lines will have to catch up and be above current price. The RSI based on 14 periods is still positive, where we're starting to get extreme with the RSI 9, which is shorter term. On balance volume continues to look positive. We're showing some improvement with the stocks in the S&P 500 above their 200-day moving average as well as their 50-period moving average. The Copic curve continues to be positive. Pring bottom fisher, who knows? Maybe this was a legitimate signal after all, but we won't know that until we can kind of look back on things going forward. Then some Fibonacci and line studies. I don't have any Fibonacci charts to show because we're above all of the current levels that we've been watching. But here's our trend line study where we broke above this green trend line and we're above this long-term trend line here. Can we stay above that? If we do start to see some pullbacks, is this red line going to be support? If we fall through that, because the green line will now be below it, will that end up acting as some kind of support? Longer term with our arithmetic scale, we're more comfortably above this long-term trend line going back to 2009. We're breaking out above the Ichimoku cloud. This had been possibly acting as overhead resistance. Now that we're above it, the longer we can stay above it, if we start to come back down, this may act as support. Some of our long-term charts, and I haven't shown this in quite a while because we were mixed up in the middle of the rainbow over here, and I should have extended this little box. But this is the S&P compared to the 3 to 7 year Treasury bond ETF. When this is going up like this, the market is anticipating a soft landing. When we're going down, the market is anticipating a hard landing. And for a lot of 2023, we were going higher. And I was showing this chart every day in the videos. Well, then we hit the summer months and things started to go a little kablooey. Now it looks like maybe we're starting to come back and look more positive. Here's the long-term daily special K chart. We're still negative here, but we're turning back up, and given another couple of days, this could cross back above the red line. And then here's the long-term chart again, just in case you missed it 2 slides ago. Here's the long-term moving average study. We're breaking above the 250 level. That's the midpoint with the 150 and the 200 day. So longer term, we're also showing improvement. Our different charts, the Heiken Ashi is still positive. The Kagi chart is positive. The Renko chart is positive. The 3-line break is positive. And we had a couple of new X's drawn in here, which is turning things more positive with the point and figure chart. We're still working off of the signal that was generated, a low pole reversal. Sounds like something you would pay to see somebody do. But it is looking a lot more positive with the trend here on this chart. Index comparisons, we compare the S&P 500 to the equal weight. Both of them were up strong, but the equal weight index is still underperforming. But when we look at the ratio over here, it did drop because this was more of a broad-based rally that we saw on Tuesday. So we just want to see, are we going to turn and go in the other direction here? Or was this just kind of an anomaly that we're just dealing with now and we'll get beyond that? Then I haven't shown this in a while. This is discretionary, looking at the equal weight ETF. It really had a good day. Staples also had a pretty good day, but we're seeing the ratio between discretionary to staples showing some improvement here and still in a longer term uptrend. Then looking at Dow theory, we were up with the Dow, the transports, and the utilities. Everything was up. But the transports continue to underperform the Dow, and we're going back up a little bit with the transports to S&P 500 ratio. We want to see a trend here. We don't want to just see this bounce and then start to go back down. We want this to continue to go up if we're going to turn more positive and have more confidence. The Dow is underperforming the transports just a little bit, but this has been kind of choppy lately. And the Dow is still above both its 50 and 200-day moving averages. As long as we can stay above this, we might avoid this death cross. And we are positive with the Elder's Impulse system for the diamonds. The NASDAQ also gapped higher. We still have this R2 level above current price, but it's actually breaking out above some previous price levels. And the NASDAQ, based on the Fibonacci, we were able to get above the 61.8% retracement level. Can we stay above it? Can we go back and test some of these previous highs? Can we break out among them? Then looking at the NASDAQ 100, it came right up to the R2 level, so that may be acting as overhead resistance. Looking a lot better here. We're above the all-time high. We're coming back and testing this previous all-time high. If we break above this and close above it, that would set a new all-time high for the NASDAQ 100. The QQQs remain, actually they've switched over to positive with the Elder's Impulse system. On a momentum basis, we're looking solid there. And here's one that I haven't shown. This is the QQQs, and then taking a ratio with 3 to 7 year bonds. They are starting to break out as the Qs are really outperforming bonds right now based on price. Small caps had a really good up day. They actually opened above their 50-day moving average, but were not able to get back up to their 200-day moving average. But you notice that real solid Friday that we had, and then we spent the rest of the week giving this back. What's going to happen going forward from here? We had a good up day. Are we going to continue to go up, or are we going to start giving that back? Here's the Russell 2000, almost getting extreme with the RSI. We were able to get above the 50-period moving average with the Russell 2000 index, but we're still working off of a death cross. The momentum continues to be positive, and the small caps have switched from being neutral over to positive for the Elder's Impulse system, and haven't shown this in a while. This is the small caps to S&P 500 ratio. When this is going up, that could be positive for the market, but it's still continuing to really underperform in the longer term. The mid caps also had a good day, hit resistance at their 200-day moving average, but opened above their 50-day moving average. Is this going to lead to something, or was just kind of a fluke? The mid caps have also switched over to positive with the Elder's Impulse system. The financial sector is still above both its 50 and 200-day moving average. I don't know what that bang was that you might have heard. The micro caps also had a good day, but are still under 100. And the FANG index is above its 50-day moving average and also in a longer-term uptrend. The tech sector is also outperforming the 3 to 7 year bond ETF, so that's showing more strength. And then home construction, haven't shown this in a long time. As we were going up, I kept showing this chart every day. Then we started to fall back. Now we're starting to see some improvement here. The dollar was down. It's still in a longer-term uptrend, but it did have some weakness because interest rates were going down. Looking at bonds, we really dropped with interest rates. Just a couple of weeks back, we were dealing with 5%. Now we're dropping down to the 4.45% level. And based on price, we did gap higher. We're above the 50-period moving average, still in a longer-term downtrend. We are looking okay shorter term with momentum, and we're above 50 and advancing with the RSI. Here's the 10 to the 5 yield curve, which has gone back to looking normal, but this has happened many times here. So we'll have to see if it stays that way. And then our possible positive scenarios, the Qs to S&P, not really a big breakout here, but both are looking pretty good. We did see some improvement with discretionary to the S&P, and that's an area that we want to see improve if we're going to turn more positive. Large cap growth actually turned down a little bit compared to large cap value, but it's still outperforming. So with the large caps, the mid caps, and the small caps, we're still above the moving averages, even though we saw a bit of a tick down. The S&P to utilities ratio is chopping around a little bit right now. If this can keep going up, that would be more positive for the S&P. Looking at the broad range of the highs minus the lows and taking a 5-period moving average, even with this solid update, we are still below zero with this indicator. The 10-day average of the S&P 500 highs minus the lows, we've crossed back above 50. That is longer term positive, showing some improvement with our new highs, new lows study, but we're still below zero. The indicator is well above zero and turning the red line back up. Here's one I haven't shown in a while either. This is the 2-year treasury yield. And when it spikes and starts to come down, sometimes that gives short to intermediate term support to the S&P. Is that going to be what happens this time? And then our staples to S&P 500 ratio continues to drop, and that often gives good support to the S&P. Looking at the 19-day exponential moving average of the advanced decline ratio, we're above zero based on price and volume. And here's the Tom Bowley research, where we're still kind of in the middle part here, where we're positive, but we could be getting into a more negative part of the month, at least according to his research. So what's our outlook for Wednesday? We do have PPI and retail sales coming out. Huge. Retail sales is just a massive part of the U.S. economy. So we'll have to see if that spooks the market or if they like that. We're still dealing with earnings season, still dealing with the whole geopolitical situation in Israel. The technicals are positive, and this is wrong here. It should be we are above resistance and we're overbought now. We will get the MBA mortgage applications index as far as that is concerned, and then retail sales and PPI, as well as the Empire State Manufacturing. That mainly applies to New York. And then business inventories, but it's retail sales and PPI that are the big ones. And then the list of geopolitical events, but Israel is still at the top there. Looking at Thursday, we will get industrial production and capacity utilization, as well as housing starts and building permits on Friday. Looking at the Stock Traders Almanac statistics, we are in the week of options expiration, where we're up about 60% of the time and down 40% of the time. For November 15th, we're positive with the Dow. We're neutral to positive with the S&P, but we're neutral to negative with the NASDAQ. We will be on the 11th trading day of the month, where we do see a little bit of weakness here, even with the green dashed line. That's a pre-election year. And we're wondering where we're at in this overall conglomeration of prices, as well as this other seasonal chart. Have we finally bottomed here and we'll start to go back up? And this chart also suggests that things look pretty positive on a seasonal basis going forward. Looking at the NASDAQ, are we going to see some weakness as we go a little bit deeper into November? Also wondering that same thing with the S&P 500. Here is Bitcoin, which I really haven't been talking about. I don't trade Bitcoin. I'm not in any of the crypto markets. I just kind of follow it because it's interesting. But we did drop down here. We're back into the 35.6 area, where after a couple of days ago, we got up into the 38 range. So our scenarios, we're not going with the down one right now, but we are overbought, but we don't know if that's good momentum or if we're going to see a reversal. So we're going with the positive scenario for right now. We're not going with the sideways trend because the ADX has crossed back above its moving average, and both of them are above 20. The warning signs, we still have the daily and weekly special K charts that are negative, the longer-term equity put-call ratio, as well as the 5-period. They're still going up for right now. The risk-on posture might be showing some improvement, but it's been showing longer-term weakness. The new high, new low studies, it is improving, but it's still below zero. The Russell, the small caps, and the mid caps still have a long ways to go to get over the death cross that was generated. The financial sector is above its 50 and 200-day moving averages. Can it stay above that and eventually get back to more of a golden cross? The positive signs are we, on a momentum basis for the S&P and NASDAQ 100, are positive. The parabolic chart as well as the vortex are both positive. The bullish percent index, it came back above 30 and is positive, and now is crossing back above 50. Small and mid-cap growth still continues to be positive. So our conclusion, we're positive, but now in potentially an overbought situation. We can say that in the short term as well as the intermediate term, where we're still positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.